A term that gets thrown around a lot when capital seekers are talking about financial information with investors is gross margin. And the question usually comes up is, a lot of times is, well, what exactly is gross margin? Well, gross margin, mathematically speaking, is a term that tells an investor or financial analyst or whoever's looking at an income statement, by the way, that's where it's derived from, is the income statement, is how profitable a company's core operations are. Because what gross margins does is it takes revenue generated by a company and applies against it only those costs directly associated with generating that revenue. For instance, if you're in a manufacturing organization, your direct labor or the labor required to maybe assemble a part and raw materials would go into what's called cost of goods sold. And those cost of goods sold would all accumulate to subtract from revenue and determine your gross margin. And again, the reason investors look at this is they use that to determine how profitable your actual core operations are and what kind of overhead you can support, and at what point, in terms of low sales, at what point does overhead start to chew up profits. If an entrepreneur or capital seeker is trying to calculate gross margins and maybe feels uncomfortable doing it or has some questions about what actually goes into the calculation, they should give us a call at the Capital Match Point. We deal with this topic a lot and would be happy to help, because at the end of the day, it's our job to maximize the opportunity of their getting funded.